What many people don't realize is that some of the largest fortunes here in America were preserved and multiplied through real estate because of the tax code. Real estate isn't just about appreciation and cash flow. It's one of the most tax-advantaged asset classes in existence. Today, I'm going to break down exactly how real estate investors, from mom and pop landlords to billion-dollar funds, use the tax system to keep more of what they earned. The US government wants people to invest in housing and infrastructure. They incentivize this through tax breaks. This isn't a loophole, this is policy. Now, if you understand these incentives, you can structure deals in a way that will maximize your after-tax returns. This is what institutions focus on. Now, the first benefit, of course, is depreciation. Depreciation allows you to write off a portion of your property's value each year as if it is wearing down. But in reality, it's appreciating. A $1 million multifamily property, excluding the land, depreciated over 27.5 years, gives you about $36,000 in annual tax write-offs, often sheltering your cash flow from taxes. Larger funds take this further with cost segregation studies, accelerating depreciation by breaking out components like appliances, roofing, or even HVAC into shorter schedules. That can generate massive upfront paper losses that offset income. A 1031 exchange allows you to defer capital gains tax by rolling profits from a sale of one property into another like-kind property. You sell a $2 million asset, reinvest it into a $3 million asset, and pay zero tax on the gain. Your capital compounds faster. Large funds often chain 1031s together for decades, effectively never recognizing gains and building portfolios tax deferred until an eventual exit. Interest on mortgage debt is deductible against the rental income. That means you're writing off a portion of your financing costs. This is why institutions love leverage. It not only magnifies returns, but reduces taxable income. Debt becomes a strategic tax shield. Rental real estate is passive. This means that the losses, let's say, can offset gains from other passive investments. High net worth investors often go a step further by qualifying as real estate professionals. The real estate professional status will allow them to use real estate losses against active income, like W-2 wages or business earnings, which can save millions in taxes. When real estate is passed down, the basis resets to the current market value. That means decades of appreciation and deferred taxes can disappear overnight. For example, if an investor bought for $500,000 and passed away with their property worth $5 million, heirs inherit tax-free property at the $5 million valuation. This is why multi-generational wealth is anchored in real estate. Families and institutions plan for transfers with this in mind. Opportunity zones are special areas where capital gains can be deferred or even eliminated after certain hold periods. Institutions deploy capital strategically into these zones to capture both returns and tax incentives. Tax benefits don't make a bad deal good, they make a good deal better. Aggressive depreciation front loads write-offs, but could mean larger gains later if not planned properly. And tax codes change, which is why institutions model different policy scenarios. In summary, real estate is loaded with tax benefits that can multiply wealth over time. It's one of the main reasons why we invest in real estate and why the wealthiest families and largest institutions do the same. That's it for today. If you want to get in contact with us, you can do so by going to the description below. I'll catch you next time.